Welcome to today's webinar, Prepping for the Economic Downturn. My name is Dennis Sullivan, and I'll be your host for today's webinar. I'm also the chairman of the Credit Union Leadership Convention that we hold every year in Las Vegas. And this webinar is a special feature of the convention to help bring you the solutions you need throughout the year. We just held our 42nd Credit Union Leadership Convention earlier this month, where there was a lot of discussion about whether we might see a recession or just a softening in the economy, or whether we may see more rate increases from the Fed as the economy strengthens. That was until last week. For the first time since the Great Recession, we saw a temporary inverted yield curve on the 10-year Treasury. The yield curve has inverted before every U.S. recession since 1955. Suggesting to some financial experts that an economic downturn is coming. That can have a huge impact on credit unions, so I've asked three of our top speakers from the convention's financial summit to return to share with you their strengths, their strategies, and recommendations to help you prepare and get the solutions you need. There has been a lot of talk in the news from a national and even global perspective, but there has been very little discussion focused on how credit unions may need to respond. We received many of your questions in advance of the presentation today, and many of them will be addressed throughout the webinar. If there is time at the end, we'll certainly address some of those that have not been addressed. Before I introduce our speakers, I want to first thank our sponsor. Our sponsor today, help make all this happen, is Excess Share Insurance. Excess Share Insurance helps you attract, protect, and retain more deposits and more members. Qualifying credit unions can insure balances up to $5 million over your primary insurance limits. For more, please go to www.excessshare.com. All right, our expert speakers. Our first speaker, and these will be introduced to you in the order that they'll be speaking, is Bill Hampel, economic consultant. Many of you already know Bill. He's well respected among credit union leaders nationwide as CUNA's former chief economist and chief policy officer. He is now an economic consultant specializing in explaining trends in the economy and financial institutions to business leaders. Our next speaker is Pete Duffy. He's managing director of Sandler O'Neill and Partners. He's an expert in competitive analysis, investment portfolio development, mergers and acquisitions, and ALM. Pete has advised hundreds of credit unions during the best and worst economic conditions. We also have with us Chris Lawrence, CFO of America First Credit Union. Chris was recently rated as one of the Credit Union Leadership Convention's top financial speakers for delivering practical solutions to help credit union leaders manage risk and still improving earnings in turbulent economic conditions. All right, so our first speaker, Bill Hampel. He's going to help set the stage for today's discussion. And Bill, I know better than to ask an economist a yes or no question. Question on everybody's mind right now. So let me ask you it this way. What's the likelihood that we will see a recession in the next 9 months? And what do you recommend credit unions begin doing now to prepare?
Oh, thanks, Dennis, but that means I can't give the maybe answer, doesn't it? So the likelihood of a recession in the next 9 months is higher than it's been for the last several years, but still far short of 1. So it's increasingly likely. The economy is as fragile as it's been, as we'll talk about in a few minutes, but there's certainly no certainty that there will be a recession. And what should credit unions do? Well, I mean, differ from most people, but I think not too much. I think the biggest risk we face in anticipating a recession is overreacting to the possibility of a recession. And I'll explain that as I go through the next few minutes. So directly to your question, the economic outlook, unless you've been really asleep or on vacation for the last 3 months, you know that the economy is just broken a record for the length of an expansion. We're just beginning the 11th year of expansion following the Great Recession of 2008 and 2009. And in August, we're now into uncharted territory. We've not had since the Civil War, which was quite a while ago, we haven't had an expansion this long. So the economy at the moment, the current functioning of the economy is quite strong. We are at full employment. The unemployment rate's around 3.6%. It's about as low as it can go. In fact, it's lower than most people thought it could go. And what that means is, and that's one of the risks to the economy, is that if the unemployment rate gets too low and stays too low for so long, it can create inflation. However, so far it hasn't done that. And this is actually surprising us that for about 18 months now, the rate of unemployment has been below the level at which most economists used to think that inflation would result. And it hasn't yet. So that's good news. But the concern is that if it stays this low for much longer, or if it tries to go much lower than this, inflation could rise, although so far there's absolutely no evidence of that. The biggest strength of the economy is the biggest sector of the economy, which is really good news. The household sector accounts for over 2/3 of all spending in the US economy, and the household sector is in really good shape right now. With the unemployment rate low, that means a huge proportion of the labor force has jobs. Wages are finally, in the last year or so, started to increase even slightly faster than the rate of inflation. Debt payments are very manageable. So that the household sector is in really good condition right now. Its balance sheet is strong, net worth is up. So those are the strengths of the economy. They are, however, also potentially one of the sources of fragility in the economy, because most recessions occur when the economy gets to full employment and overshoots or overheats, causing inflation, which then causes the Fed to react to that inflation, which leads to the subsequent recession. Again, no sign of that yet, because this time we don't have inflation coming along with the approaching and being at full employment and full capacity for the economy. The economy does have some other fragilities right now, some other things that could mess things up, basically. The rest of the world's economies are slowing. The European economy is borderline recession right now. The Chinese economy, although growing, is growing at a rate slower than it has for quite some time, and there's concern that the Chinese economy, which is very large, could be slowing. The U.S. does export quite a bit of goods and services, and so if the rest of the world's economies are slowing, that slows the demand for U.S. exports. There's trade policy. If the tariffs we're having, the potential tariffs, from day to day, the tariffs are on again or off again. That does a couple of things. First of all, it creates uncertainty, and financial markets don't like uncertainty, and also businesses who are planning their investment behavior, they're buying plant and equipment and machines and tools and all those, and deciding whether or not to hire. They also don't like too much uncertainty. So this is likely to slow down business investment spending. But we also export quite a few of our goods and services, as I said before, and if we impose trade tariffs on other countries' goods, they're likely to retaliate, which will also further reduce our economic growth. If you want to see if what might be a little bit scary, wait till after this webinar, of course, but Google Smoot-Hawley, Smoot-Hawley. The Smoot-Hawley tariffs of the 1930s are widely believed to have dramatically worsened the Great Depression of the 1930s. So this is one thing, that most economists agree on, maybe 98 out of 100 economists agree on, is if you impose tariffs, if you mess up international trade, you hurt everybody, including your own country. On top of this, we have the inverting yield curve, and I'll talk about this in just a second. And Dennis, you mentioned this before, when short-term rates get above long-term rates on the Treasury curve, this has been a very powerful, reliable indicator that economic weakness or a recession is down the road in the near-term future. And we've had some measures of an inverted yield curve. This is causing some greater consternation. What all of this does is it affects business confidence and business investment spending. Business investment spending is about 15% of GDP. It's already weakened in the second quarter of this year, and the concern is it'll weaken further for the rest of the year. So then when they throw into the mix here Fed policy, what's the Fed going to do? Not too long ago, probably the beginning of this year, the debate was whether or not we would get 2 or 3 further increases in the Fed funds rate by the end of this year. Well, instead of that, we've already had 1 decline, and then the debate now is how many more and how strong are they going to be. So we've had this fairly substantial turnaround in Fed policy. So here's the story with the yield curve. This first one you see here is November of last year. That's about the recent peak of interest rates over the last couple of years. Actually, it's not quite right. October was the peak, but I had November already built into my system, and it's within a couple of basis points of October. So this is essentially about as high as interest rates got. This yield curve is sloped the way Mother Nature wanted yield curves to be sloped. As you move from left to right, it continually rises. The longer someone commits money for, invests money, the higher the rate they're going to earn per period, because they're exposing themselves to more risk because it's just a longer time over which bad things can happen. This is the current yield curve. Well, actually, current can mean lots of different things. Today's yield curve is actually about 5 to 8 basis points lower than this one. This is the average of the daily closings for the first 2 weeks of August through last Friday. So this is the yield curve for the first half of August. It was during this period that the financial markets were getting so excited. This is this inverted yield curve. Notice that it's actually inverted from 3 months down to 5 years. It's falling from 3 months down to 5 years, and it rises after that from 5 years out to 10 years. You may notice that most people show yield curves out to 30 years, but since we're credit unions, and if you did much with a duration of longer what a bullet security of 10 years would be, like if you bought 20 or 30-year fixed rate government bonds, your examiner would take you off in handcuffs next time they visited you. So I don't even look at beyond the 10 years, although it does continue to rise slightly after. It's positively slow from 10 out to 30 years. So that's the current inverted yield curve. Now, why are we worried about inverted yield curves? Well, this is why. This goes back to 1953, so there's almost about 65 years here. And the shaded areas there are every recession we've had since 1953. And the purple line there is the 10-year, 90-day yield curve. It's not the 10-year, 2-year, it's the 10-year, 90-day yield curve. And what we see here is that the first 3 recessions, this was not the case. They were not preceded by an inversion, and we were also then, the economy was getting over World War II and the US's new role in the world economy. So that was really ancient history. But ever since the recession of 1970 to 71, every single recession has been preceded by an inversion of this yield curve. And we've only had 1.5 sort of examples of false positives. Back in 1966, the yield curve inverted and we didn't get the recession until 3 years later. And then it really doesn't show up here, but in 1998, there was a slight inversion of the yield curve for a short period. It didn't show up on a monthly average for this record, and the recession didn't come till 3 years after that. So this is why we worried about inverted yield curves, because just about every time they happen, we're followed by a recession, and we hardly ever have false negatives. So just to show you, that first of all, you might notice that the right-hand chart here, where my pointer is now, this looks like it's barely inverted compared to the huge inversions we had back in the late 70s and early 80s. Actually, in proportional terms, this inversion here, when short rates are 2% and the 10-year was 1.7, in proportional terms is not too far off of the inversion back here when short rates were 15% 15, 16%, and the long rate was 13%. So this is just because interest rates were so much higher back then that the difference between short and long-term rates looks stronger. But actually in proportional terms, this current inversion is just about the same size as these inversions back in the 1970s and 1980s. Just to show you, this is the last few years of the previous slide, just to show you where we are. The 10-year 90-day curve inversion has been inverted for the past 4 months, basically. In May, it went to 0. In July, it went to minus 15 basis points, back up a little, I'm sorry, June to 15, July to minus 9, and in August, it was 30 basis points. So that's one possible measure of the yield curve. There are a few other inversions. As I said, the 10-year 90-day is, so far this month, is at minus 30 basis points. The 10-year 1-year has averaged 9 basis points for the first half of the month. And interestingly, the one that got everybody so excited last Tuesday and Wednesday, that was splashed all over the news and TV and CNBC and Bloomberg, was the inversion of the 10-year 2-year. Well, it never actually closed inverted. For a few minutes here and there, it was maybe inverted by 1 basis point. And if you look back at the previous chart I had a minute ago, the yield curve needs to get inverted and stay that way for a little while for this actually to mean something. So the 10-year 2-year inversion that we had last year was very brief, very fleeting, and is certainly not enough yet to say that that's an inversion of that curve. Although quite a few folks have done work to say that the 10-year 90-day, the one on the top there, is the one that tells us the most, has the most predictive powers about inversion. Now, before I move off of this, just, we should ask a little bit, what is it about an inverted yield curve that suggests that a recession might be around the corner? Well, first of all, there's nothing, an inverted yield curve does not cause a recession. The same way something, high inflation causing the Fed to raise interest rate can cause a recession. The collapse of a housing market hurting financial institutions can cause a recession. An oil price embargo causing the price of energy to soar and mess up economic arrangements can cause a recession. An inverted yield curve in that sense doesn't cause a recession. But what an inverted yield curve does is it represents the feelings, that the expectations of economic agents, both businesses and investors, that suggest that a lot of people are expecting a recession. It's basically like a futures market projection of the future. And essentially what it means is if investors and businesses believe that the economy is going to weaken in the next couple of years, then they believe that that interest rates are going to fall over the next few years. And as a result of that, they buy fixed income securities now to buy them before the decline in the interest rate. So they're trying to get ahead of a weakening in the economy. So it's kind of looking at a mirror. It's telling us what we collectively think is likely to happen as opposed to causing something to happen. The other thing that might tie into this is that an inverted yield curve could in part be caused by concern about the future of the economy, meaning people expect the stock market to be weak and therefore they're getting out of stocks into bonds, which pushes down interest rates, especially longer term interest rates, which might be more substitutes for equities. So I hate to upset you this early in the day, especially out on the West Coast, but we really don't know why inversions presage recessions with such regularity. But those are some of the possible explanations of why this might happen. So summing up all of this, we are incredibly likely to have a recession sometime in the next 3 to 4 years. No, that doesn't help, but that's what we can say. With the economy at the late stages of a business cycle at full employment, it's very hard to maintain at full employment indefinitely for a long time. Something can come along to bump us off. Either some shock will come to knock us off, or inflation will finally kick in and the Fed will have to react to that to cause a recession. The inversion of the 3-month 10-year yield curve suggests that the probability of this is rising, and it could be in the next the probability of recession in the next year or so is as high as it's been for quite some time, but it's nowhere near 100%. So since we are more likely to face an economy than we have been for quite some time, let's see how recessions affect credit unions. So these next few slides here, I got I think 4 or 5 of them, and they're all the same format. So I'll explain the first one. What I've got here on the bottom, we're going to look at 5 recessions: the one in 1980, the one from 81 to 82, 90 to 91, 2001, and then the Great Recession of 2008 to 2009. The numbers along the bottom here are years. If a recession occurred over 2 years, like say the 81 to 82 one, these 2 zeros are the 2 years during the recession. This is the 1 year preceding. This is 2 years before the first year of the recession. This is the year after. That's the second year after. If the recession only occurred in 1 year, like 2001, the 0 is the year of the recession. This is the first year after, second and third. These are the 2 years preceding. So that's the same format we'll use for all of these. So the first one here is I'm looking at delinquency rates. This is in the 1980 recession. Delinquency rose from about 2.25% to 3.5% at the first year of the recession, leveled off, and then fell. This is the next recession, and there's an overlap in these first two, so they don't tell us much new information. Similar, it rose, leveled off, and then fell. The 1991 recession, it's not moving for me for a moment. Dennis, could you click it once too and see if you get it to advance?
Yep, it's moving still.
Okay, well, I'll just start talking until it goes back. You just have to take this on faith, because I wouldn't make this up for you. Oh, we just bumped ahead several times. Let me go back up. Don't look, because you'll get their punch mode. There we go. In the 1991 recession, that's delinquency before, during, and after the recession. Looks to me like it fell. The 2001 recession, basically flat. Now, the Great Recession, quite different. Delinquency went from around 6-something to almost 2% before leveling off. And you know that the increase in delinquency in the Great Recession looks like it wasn't actually much worse than back in 1980. However, in proportional terms, in 1980, delinquency went from 2.25% to 3.25%. That's less than a 50% increase. In 2008 and 9, delinquency went from 0.6% to 1.8%, which is a trebling of delinquency. So if the last recession was much, much more severe. Provision expenses related to delinquency. So this is the same format, and this is provisions to assets, not provisions to loans. Loan loss provisions expense during the year divided by assets. 1980, a slight increase, not much to write home about. 1981 and 82, similar. 1990, something of an increase from 40 basis points up to 50 before falling. So from before the recession to during the recession, provision expense account would have accounted for a 10 basis point reduction in ROA, other things being equal, before falling off after that. In 2001, that black line there just showed up, didn't do much of anything, actually fell into the recession, rose a little bit afterwards. Again, last time, very different. During the Great Recession of 2008 and 9, provision expense went from about 30 basis points to around 120 basis points before coming back down. This, you know, we talk about what happened to us 10 years ago. It was much less the corporate crisis, although that was significant. The biggest driver of the reduction in credit union earnings over the period wasn't corporate write-offs or insurance premiums. It was increases in loan losses. But just look at this one for a minute. Up until the Great Recession of last time, provision expense basically doesn't change much during recessions. Last time it did, previously it didn't. So just keep that in mind. ROA in recessions, this is the 1980 recession. ROA fell from about 80 basis points to 55 or so during the recession, then rose again after that. During the 81 and 82, similar. During 1990, ROA was from the high 90s to the low 90s before and into the recession, and then after that soared up to 120 and 130 basis points. 2001, no change. You know, that was in the old 1% days when ROA every year was between 90 and 100 basis points, no matter what was happening to anything else in the world. And whoops, this is again 10 years ago, 80 basis points down to negative in 2009, and gradually rising in 2008 and 9, and gradually rising after that. So once again, in terms of ROA, not a huge effect from a recession, from a quote normal recession, but give us a great recession again, and we've got significant effects. Loan savings ratios, your liquidity, and these are all very similar. We get a substantial decline in loan savings ratios, a substantial increase in credit union liquidity going into and following a recession. This is because of our members' behavior. When there's a recession coming and around, and they tend to the recession psychology lingers for them for a while. They want to save more in case things are bad. There's a flight to quality because they're worried about the stock market, and they're not going to borrow as much because they're worried about paying back loans in case they lose their job. So here's 1980, there's 81 to 82, 1990, 91, 2001, and then the Great Recession. All of those things to varying degrees are falling from left to right. So to the extent there is a recession or even just a weak economy, you can expect an inflow of liquidity over the next few years. So therefore, summarizing all of this stuff, 3 takeaways that I think in the current world we should keep in mind. The first one is don't panic. A near-term recession, although increasingly likely, is by no means certain. And even more significant, if we do have another recession coming up in the next year or two, it is incredibly unlikely to be anything near as severe as the Great Recession of 10 years ago. That recession was as bad as it was primarily because it was driven by a financial crisis. And when you have a financial crisis, you have financial institutions, especially big ones 10 years ago, hurt, and they have to retrench and tuck in their horns. And when they cut back, that really hurts the economy and hurts the recovery. So the only thing on the horizon now, we don't have the sort of excesses. We don't have huge inflation built up. We don't have a huge overly priced asset anywhere. The only thing that could cause a recession to get really severe is if the trade war gets incredibly bad. And I hope cooler heads will prevail, but in wars, leaders often do really dumb things on both sides. And so it's possible that a mild recession could spiral downward into a much more significant thing if the trade pressures get much worse. But I think that's incredibly unlikely. The second suggestion then is to let your capital do its work. We build capital in good times to absorb some shocks in bad times, and so don't act like you need to maintain an unblemished capital ratio throughout a recession. If you do have something of an increase in loan losses, and so your earnings fall for a little bit, so your capital ratio falls a little bit, big deal. I mean, if you are operating on a really slim capital margin now, that's one thing. But if you're like the 95% of credit unions who are not, having your capital ratio fall a little bit during a recession so as not to have to make some nasty decisions during the recession to protect your capital ratio is why you built your capital in the first place. So let it do some of its work. Let it absorb some of those shocks. And then the third thing is to actually look at this as an opportunity for your credit union. There are some weaker institutions and institutions which have more risky balance sheets for whom an increase in losses or risks due to the recession will cause them to have to make retrenchments and pull back. They're going to leave some bluer waters there for you to swim in. So you can look for opportunities to grow and serve more members and do more things in terms of, some people are going to have to shun deposits because they don't want to grow and lower their capital ratio. There's an opportunity for you to pick up some deposits, even if your capital ratio does fall a little bit. Look at point number 2 above. And similarly in making loans. So I think there are opportunities here. But the main thing is to not overreact. The recessions, for the most part, as we saw from the previous slides, most garden variety recessions don't hurt credit unions all that much. So, Dennis, I'll turn it back to you.
Thank you, Bill. So you did a terrific job setting the stage there for us. And, I'm particularly interested in learning more about some of these opportunities you talked about. In the meantime, we have Pete Duffy talking about some of the strategies that you can employ in case of a downturn, but also in terms of opportunities, too, to pick up right where Bill left off. So Pete's Managing Director of Sandler O'Neill. Pete, take it away.
Okay, thanks, Dennis. And can you confirm you hear me okay?
Hear you just fine.
Okay, great. Well, good afternoon, everybody from the Big Apple in New York. As Dennis said, we're going to cover some thoughts about how to deal with turbulent times in the business. I'm going to see if I can get my slides to move. It went into, it was in delay mode. So let me go. I don't know, for some reason I'm going into Chris's slides.
I'll move you back.
Suggestions? All right, here we go. Okay. I think we're under control now. Well, first of all, the net interest margin erosion that we're seeing in bank and credit unions has actually been occurring as a long-term trend since the late 80s. And it's due in large part, but not limited to, there are more lenders than Americans need. In fact, I say often America has more lenders than Americans need. Americans ruthlessly shop for the lowest loan rate and the highest deposit rate, and technology has made it easier to rate shop for consumers. That's commoditized the financial offerings of banks and credit unions, and when the product is commoditized, you have no pricing power, and that's driven margins tighter, both ends against the middle. Cost of funds up while yield on earning assets are down. The flattened and inverted yield curve exacerbates that for everybody. So the interesting thing here is your institution is facing the exact same issues of the business and margin pressure that your competitors are. So it really comes down to how are you going to react? Because the reaction can end up becoming a competitive advantage versus the wrong reaction can mean a very difficult time for your institution or those that you compete with. We think that an important competitive reality of the business today is actually not very well known, but you see the result of it. So let me explain. Due to changes in regulation coming from Dodd-Frank, the bank industry has seen their DNA be rewired. Large banks, and really now all banks, strongly favor core deposits like never before. This is forcing cost of funds up for all marketplace participants, and it started a couple of years ago. We suggest that understanding this more deeply before you decide to change overall strategy or tactics, because the impact on the business, we believe, is long-term. We had some analysts run an analysis of 15 major markets in America. These are the kind of cities that you would think of normally as a major market: New York, Chicago, Boston, LA, Dallas, Tampa, Houston. And in every one of those markets that we looked at, the banks are now outpaying credit unions for deposits. And it's been that way for a couple of years. The battle for core deposits will impact margins permanently, regardless of the shape of the yield curve, and to the net interest margin detriment of banks and credit unions that don't have enough scale. We'll be happy to share that research with you if you reach out to us, but the market turmoil today, should a credit union change its strategic plan, That's the higher level thought. And then we'll get into some strategies and tactics. You all know well enough, recessions come and recoveries come and they go. The most important strategic consideration, though, remains the same. Is the strategic plan that my institution's on, is it objectively and comprehensively correct with specific respect to achieving, retaining economy of scale? We're in a commoditized business. If you look at the loan-to-share ratio of credit unions 10 years ago to today, it's up, and it's up significantly, but ROA is down. The reason for that is the loan offerings of banks and credit unions are commoditized. It's hard to differentiate without scale. What I often hear said in many ways, but capsulized here from the CEOs and boards of the institutions that we visit with and advise to, my institution needs to be growing at an above average pace to competition while my ROA and capital accumulation keeps pace with my growth. If not, something's wrong and I need to do something about it, because it eventually, if not now, is going to affect the value that I can offer my membership. So on a high level, we talk and advise with our clients on strategic considerations for today and going forward, regardless of the rate environment. Understand what fintech is in the business today and figure out if it makes sense to participate with fintech as a partner. I'll explain more of each of these in a minute. Develop a strategy for productive merger. Whether you're a buyer, a seller, or you don't know, you really need to be understanding the role of merger in today's financial institution business in America. Build a fortress balance sheet. Do rigorous analysis, holistically considered, and find suitable ideas to build your earnings, because I differ with Bill, you can't have enough capital, liquidity, and earnings. Even if we have a recession and it affects delinquencies and you charge off loans and some capital goes down, yeah, sure, it's good to have a cushion, but it also means you may have to slow down your growth. And that's frankly unacceptable to the institutions who really look at scale as very important in order for them to continue to be able to do what they need to do for their customer base. Our strategists are analyzing and coming up with ideas for our clients to steal their margins from the ravages of prepayment risk and reinvestment risk, which have already started to occur. You've got bonds in your investment portfolio and loans on your books with the lower rate environment where the underlying homeowner or consumer is going to refi that debt, and that money's going to come back in a lower rate environment. That's reinvestment risk. That requires some study and some careful consideration about protecting your margins and ROA and capital. One of the ways to do that is with the investment portfolio, because you can make every decision about the investment portfolio while your member and competitor decides the loans and shares and rates that you offer. And then consider capital raising by selling Visa Class B shares for those that have it. So a little bit about selective productive partnership with fintech. We think it's an opportunity to diversify the loan portfolio and generate new members and increase your ROA, and some credit unions have already begun to do that. And by the way, some of the most successful credit unions in America are or are underway ramping up with fintech. It'll bring loan portfolio earnings for your credit union more in line with your competition. One of the reasons to consider this, fintech now is over $15 trillion in loans written in America. In 2008, non-bank companies accounted for 20% of the country's non-mortgage credit and total residential mortgage business. And just 10 years later, fintech or non-bank companies have 58% of the residential mortgage and non-mortgage credit business in America. They have already disrupted the business. The good news is they really wanted to partner with depositories. In just 3 years, we've helped fintech companies partner with a handful of credit unions who collectively, in a very short period of time, have generated over $1.5 billion in new loans to new members. And most of that is with just 5 of the credit unions who are underway with fintech. We're close to 11 now. Multiple collateral types are available in this regard, from home equity line of credit to residential solar, where a lot of credit unions are having some real fun, RV and marine loans, and others. So the question would be, how can you participate? It depends on your credit union. It depends on your interest. But it does require robust support from the top of the credit union and throughout the organization, and a willingness and ability to originate members on a regional or national basis. If that doesn't fit for you, you can participate with fintech offerings by buying participation loans from the originating credit union. These loans are available. We've been selling, well, we're well over 120 million in participation sold just this year. And these are loans coming to the participant at nice yields and good cash flows, underwritten by a credit union you may know. The other part of the high-level strategic consideration is the consolidation or merger. We believe is likely the next inflection point for banks and credit unions. And the question is, are you ready? Recently announced mergers have boards of credit unions we visit with really wanting to understand how merger can play a role in achieving and retaining scale. When you look at a merger such as SunTrust and BB&T, which creates a $442 billion asset institution, Rabobank and Mechanics Bank in California at $17 billion, Schools First and Schools Financial in California, also $17 billion, recently closed Gieson and Spiris, Consumers and Indigo in the Midwest, and Vibrant and Infinity. These are mergers where, if you read the press releases, they're essentially saying the same thing. We're not big enough. We need more scale in order to compete, be cyber secure, and have the best technology possible for our customer base. The trend arguably started in the 2 deals we advised on in the last year, where Denali decided to merge with New Vision and McGraw-Hill with PenFed. And currently we're in talks with 5 different mergers, and on 4 of those 5, both sides of the merger are greater than $1 billion. And these are credit unions who are essentially saying, we need to compete more effectively against the larger institutions because they really want our customers now. Based on our research that we did to describe and understand what's a top performer in the credit union space, among other things that we learned, the analysis implies that very few institutions will achieve and maintain economy of scale without productive mergers. So we think it's a good time to start understanding how merger might fit your overall plan. Another more high level, but a little bit more granular, the bank investment portfolio remains a strategic advantage over credit unions, but it really doesn't have to be, because we know credit unions whose investment portfolio is on a par or better than their neighboring banks. But the blue line there, which is the bank industry's investment portfolio yield going back to 1995, the orange line being the credit union investment portfolio year, as you can see year in and year out, with 2 exceptions, banks are averaging anywhere from 30 to 200 basis points more in yield. The good news is you can match that performance with a little more analysis and understanding of how that can be accomplished. That's hundreds of millions of dollars depending on the size of your investment portfolio. Heads up on the lower rate environment, and as we mentioned, people more willing to refinance their mortgage or their auto loan or their student loans. Prepayments are coming in. This can cause lower yield on loans and investments and reinvestment risk. Certain loans and investments are in the money or will be, and this requires some thought to analyze each asset on your balance sheet to determine, is it a good time to pair it off with other assets at a gain and move them off the balance sheet and protect your margins. So analyze balance sheets and investment portfolios for vulnerabilities and opportunities to protect against margin compression. And then the last thought there, we've advised, and there have been, I think we've done the most of these. There's an opportunity for credit unions that doesn't come along very often to raise capital. And that's through the sale of your Class B Visa stock. This is a way to build capital, build earnings. The earnings is on a short-term basis. The capital can be considered on a long-term basis and improve liquidity. That's a transaction that's available to some, not all. And if you'd like to hear any more about our research on core deposits, balance sheet strategy, the merger due diligence topic, and the analysis on top performing credit unions, or hear more about the ideas to protect your margins from fintech and Visa Bs, just give us a shout or call your Sandler O'Neill coverage. Thanks, Dennis.
Thanks, Pete. All right. Be good now to get a good perspective from the tactics that we could look at from a CFO's perspective. And Chris Lawrence presented in August or a couple weeks ago at our credit union convention. Did a terrific job, rave reviews, because he was able to give such practical guidance from the perspective of the CFO. So Chris Lawrence is CFO of American First Credit Union. And Chris, take it away.
All right, thank you, Dennis. Before we begin, just want to make the disclaimer, use this advice at your own risk. American First Credit Union and I are not liable for any decisions made from this advice. Having said that, you should do everything I'm about to talk about. So, preparing your balance sheet. First thing, I believe this all the time, avoid hubris. Where interest rates going, nobody knows. Even the Fed, who are determining our interest rates, do not know. Their dot plot is consistently wrong. So just have some humility in acknowledging that we don't know where rates are going. So don't plan on them going up, don't plan on them going down. Just balance your balance sheet and be prepared for whatever might come. So what to expect in general right now. So rates have fallen quite a bit over the last few weeks. You are going to have a lot of refinances. So you're going to have cash, and more cash. So your runoffs are going to increase. This is already happening. These are just in the pipes. If they're not in your pipe, they're in somebody else's pipe. So your loan is going to go away. So how are you going to maintain these funds? And if a recession takes hold, you're also going to have even more cash because you're going to have a flight to quality. People are going to pull out of the market. They're going to put their money in your institution because it's insured. So that's even going to make you more asset sensitive, which gets me to the point that most credit unions are already asset sensitive. So what this means is that earnings are going to hurt in declining rates, and they're going to benefit in rising rates. Are rates going to fall? Again, back to my previous slide, I don't know. And you don't either. So for asset liability models, check your assumptions. Look at your decay. I know the decay of my institution was truncated at 3 and 5 years, depending on the deposit type, on the savings type of account. And that truncation was conservative for rising rates, but it's aggressive for declining rates. So don't play games with your assumptions. Try to get it as accurate as possible. You need a pretty real picture of how your balance sheet is going to react in different rate environments. with that, you also need to, when you're doing shocks and stuff, look at different curves. So you might need to, you have a bull flattener, a bear flattener, or a steepener. Your ALM should be taking all of these into account. That's really important for maintaining your income, or at least mitigating some of the losses that are going to be felt in a recession. If you are asset sensitive, so lock in your assets. You can do this with, I'm a big fan of utilizing your investment portfolio to temper the rest of your balance sheet. So whatever the rest of your balance sheet needs, you can do it with your investment portfolio quite often. So most of us have a lot of prepayment risk in our balance sheet. In other words, our borrowers can refinance their loan if rates fall, which means we're going to get money back when rates fall. That's a little bit rough in a declining rate environment. So if you buy a muni or a CMBS, so CMBS or commercial mortgage-backed securities, those are prepayment protected. In other words, the borrower, it's very disadvantageous for a borrower to prepay a loan that has either yield maintenance or some sort of prepayment protection on it. You can build in down rate protection by buying these instruments. Munis also, they can't just refinance, quite often. So, and by the way, these are going to outperform any auto participation that you've ever bought. They have less credit risk. You can actually resell them. If you buy an auto participation, you can't resell it. They have better returns. The cash flows are very predictable, again, because they can't prepay. So in other words, there's no convexity of cash flows in there. Other aspects, you might want to lower your rates on your longer term aspects. So if you're doing auto loans, match your rate for 5, 6, or 7 years. Why are you enticed or preventing your members from, or dissuading your members from doing a 7-year auto loan versus a 5-year auto loan? You actually probably want those loans on your books a little bit longer. So doing a 7-year term at the same rate as your 5-year term might make sense. You also probably want to lower your rates on your longer term liabilities. So your 5-year dividend might be the same as your 3-year dividend, and you're not necessarily going to upslope those. Certainly the opportunity cost from a borrowing perspective or the market perspective, the market is telling you you should pay less on longer terms if you're doing a 5-year. So everything that you just saw in Bill's slides with the inverted yield curve, you have a 3-month CD versus a 5-year CD, the market is saying you should largely be paying less for 5-year money than you're paying for 3-year money. Now, if you are liability sensitive, and I highly doubt this, there are some out there, but you are very, very rare if you are liability sensitive. So if you're liability sensitive, you should extend your liabilities. You can do that through improving your pricing on your longer term CDs. So go ahead and up the 5-year, right? Everything's going to be the opposite as if you're asset sensitive. You also want to lock in some borrowings. Another part of this, you probably should increase your CD penalties. And if your members are making a contract with you for 5 years, they need to hold to that contract and give you that money for 5 years. So you're paying them largely, likely a higher rate for that money, and it needs to be somewhat painful for them to get out of that contract, because you need to depend on this from an asset liability perspective. So, or you may even want to offer longer term offerings. Maybe do a 6-year, 7-year CD. And I think the easiest thing to do, which is kind of anathema in our industry, is to take out borrowings. Borrowings are a great way to manage your balance sheet. If you have overnight borrowings, you can pay them back and shrink your balance sheet and protect your net worth ratio if need be. if you're liability sensitive, then go ahead and lock in some long-term borrowings. And that way, when rates rise, you're going to be able, you're going to increase your asset sensitivity. You're going to be able to increase your income in a rising rate environment. So right now, you can borrow from the Federal Home Loan Bank of San Francisco. Everything is well below 170. Some of these terms are actually below 160. So look at this and what you're paying. We're all here to pay our members. So ideally, I'm going to pay my members instead of the Federal Home Loan Bank. But the Federal Home Loan Bank is a great way to manage your cash flow and the financial security of your institution such that you can give your members more. And then on the asset side, shorten your assets, minimize portfolioing your 30-year loans. If you're liability sensitive, minimize long securities. So if you have 15-year 2.5s in your portfolio, go ahead and sell them. If you have 30-year MBS in your portfolio, now's a pretty good time to sell them. You might want to buy SBAs or short hybrid arms or even post reset arms. So hybrid arm is a 5-1 arm where it's fixed for 5 years and then floats after that 5-year period. So if you buy something that's close to that reset, you now have a floating rate asset. And cash is a great asset sensitive asset. So if you are liability sensitive, you need to increase your asset sensitivity. So hold cash. Holding cash today does not cost you too much. When it was 3 years ago, when Fed funds was 25 basis points, holding cash cost you a ton. But today it's not as expensive. And lastly, because we only have like 2 minutes left here, if a recession is truly on the horizon, one, don't bet on it, just like not betting on interest rates, but be prepared if it does happen. So buy treasuries, keep money in cash, depending on your ALM results, you want to do that. If you're going to either buy a 3-year treasury or cash, and that depends if you're liability sensitive or asset sensitive, or maybe you want to buy a 5-year treasury or 7-year treasury. I would stay true to your credit right now. So don't start creeping in order to get assets, because it's pretty competitive out there. And I would largely avoid new asset classes. So don't get into things that you're not familiar with. And I just talked about munis and CMBS. If you're not really familiar with munis and CMBS, you might want to get smart on them before you buy them. Getting into anything new is always has an intrinsic risk in it. So make sure you have the expertise in-house to go down any of those roads. And then I'm going to say it again, don't bet on it, but hedge against it and be prepared for it. So with that,
all right.
Back to you guys.
Thank you, Chris. That's terrific advice. And you can see why we asked each of these speakers to come back. They did a terrific job several weeks ago at our convention in Las Vegas. And I want to thank them. Bill, thank you. Pete, Chris, for each taking the time to walk us through how perhaps we should prepare for whatever may come, whether it's a recession a few months from now, a few years from now. It's terrific advice that we could all use. A reminder, we are already beginning work on our 43rd Credit Union Leadership Convention, where we'll have each of our 7 summits there, including the Financial Summit. It's basically 7 conferences within one big convention. Our keynote speaker is Marcus Luttrell. You may remember him from the movie Lone Survivor. Incredible story. He's going to be keynoting to kick off the convention next August. We are already preparing for that, and welcome each of you to get more information. Just go to culeaders.com, opt in to get our brochure, and that will give you the largest discount that we're going to be offering for the convention. So I encourage you to do that. And also, I want to thank again our sponsor, Excess Share Insurance, help you attract, protect, and retain more deposits and more members. Qualifying credit unions can insure balances up to $5 million over your primary insurance limit. So please go to excess.com for more information. Again, thank you to each of our speakers. Thanks to you for taking the time out of your busy schedules to join us, and we hope you find it valuable. Just a reminder, we will be sending you a replay of today's webinar so you have it, and feel free to share it. Thank you again, and have a good day.